So welcome to our new ESG module. Today we have with us Denise Vos, Chairwoman of LuxFlag, and Sachin Vankalas, General Manager of LuxFlag as well. LuxFlag is the Luxembourg Finance Labeling Agency, an independent international non-profit association. It aims to promote the raising of capital for the responsible investment sector by awarding different labels in investment vehicles in microfinance, environment, climate finance, and green bonds. Today, Sachin and Denise will introduce us to ESG and impact investing and also to different ESG strategies. Do not forget to ask your question by using the chat function or by raising your hand. In the end of the module, you will receive a survey and also access to the recorded sessions. So welcome, Denise. Welcome, Sachin.
Thank you. Thanks very much. Welcome, everybody. Sachin, do you want to, I can say welcome to everyone. I appreciate you spending your lunch hour and a half learning about ESG and obviously focusing on private equity. I think there's an interesting group of you here. Sachin and I teach at the university, and generally the students there have not so much experience or background in ESG, but when I look at the list of participants, I'm quite impressed at the experience in terms of the industry. And I'm sure many of you have obviously been doing quite a lot of reading or even ESG experience. We see we have a responsible for ESG attending as well. So I hope, Rebecca, you're not too bored today, because today is really just about sort of setting the scene, really, what is sustainable finance with a particular focus on the strategies. Obviously, tomorrow and Monday we'll look in more detail and obviously focus more detail on some examples in respect of private equity. We have a lot of slides today, and Sachin will take the lead on the slides, and I'll kind of comment and help in terms of looking out for questions as well. We will go quickly through the slides because there are a lot of them, and I think, again, a lot of this you probably are aware of, but it's still worth going through. Please do ask questions. We've been told it's perfectly fine from a technical point of view for you to put your camera on, and it's certainly for us much nicer to see your faces. Feel free again to ask questions in the chat function and also by raising your hand. So again, I will work with Sachin to try to get those questions answered, and we'll also stop from time to time to see if you have any questions. So I leave the floor now to Sachin, and I hope, I'm looking forward to this. Thanks. Bye.
Thank you, Denise. Thank you, Abby. Good afternoon, everybody. Well, it's very nice to see you all of you around. Before starting, our assumption is that, of course, many of you or almost all of you work in the fund industry in different ways and different functions. So you have all the basics around funds and let's say financial instruments as such. And also our assumption is also that, there might be some slides which are going a bit too basic. But if there is too basic, or if we are going too much in detail, which doesn't need to be, then you just let us know, right? So that there are some assumption we are making that, okay, there are some important elements in ESG. Let's focus on that. But in addition to that, if you have any questions or so, you always let us know. Yeah. So today we are going to deal with fundamentals, just basics of what is ESG, and often it is also known as you know, sustainable finance, responsible investing, ESG investing, impact investing, quite many different terms, which probably you heard about. Before going into really the finance element of ESG or sustainability as such, let's go back to the very basics. What is exactly sustainability? What are we talking about when we speak about sustainability? Often something comes to people's mind is sustainability means something to do with green, right? Or something to do with the nature, or something to do with, let's say, resources. But if we go a little bit detailed, we see often when we ask this question to people, these type of pictures come to mind. There is something happening in the north, so ice is melting, or something is there, something is happening. And that's what relates to sustainability or climate change as such, which is also often relating to sustainability as such. That's what a reaction which comes as answer to the question of what is sustainability. One more thing also comes often is, there is a lot of dependence on fossil fuels, a lot of dependence on, let's say, there is a whole lot of pollution around. And so how could we use alternative ways of energy, renewable energy, solar energy, wind energy and all that. And that has something to relate or something to do with sustainability. That's also one of the comment or one of the picture comes to the mind of people when we speak about sustainability. And this picture you probably have seen, it's Solar Impulse, a flight which was almost across the globe, and a specialist took over, which was powered by, of course, solar energy as such. One other element which comes to mind when we speak about sustainability is, that's something to do with weather, that's something to do with climate change as such. And there have been a whole lot of these fires around in Amazon or in other regions of this planet, and that is something bad, or that is something to do with weather as such, right? Or this also something, right? When it comes to sustainability, these new electric cars or these, and that guy who is just sitting next to the Grand Duke, he's the guy who took over the Solar Impulse, right? The flight on solar energy all across the globe, right? So those are the kind of, let's say, images, those are the kind of pictures come to mind often for those who do not work day-to-day basis on sustainability as such. They come to mind to people. But when we speak about, let's say, when we try to, let's say, scientifically define what sustainability is, it refers to the practices that meet current resource needs without compromising the ability to the future needs. Meaning, I'm living on today and I'm not borrowing anything from tomorrow, right? In very simple words, that's what it is, right? So we limit our needs, or we let's say adjust our needs. And when we speak about needs, it's not only physical needs, it's not only material needs, but overall our way of living in terms of food, in terms of transport, in terms of money, in terms of other resources, right? Everything what we have as a, let's say, society or as a planet is limited, resources are limited, and we live on resources which are available at today and not necessarily borrow something for the future, right? That's more, let's say, if we want to put, let's say, sustainability in more, let's say, word format or theoretical format. But is sustainability something relating to green only? And that's the question which we often come across is most of the topics which we see around sustainability are coming very much related to green or very much related to climate change as such. But is sustainability related to only green? We'll certainly see that in more detail as such.
And maybe if I can, yeah, I mean, I just wanted to kind of emphasize that point. I mean, clearly, sustainability has traditionally been about the climate, but since COVID-19, we've seen much more focus on social issues, such as access to healthcare, how companies treat their employees and the like. And clearly, you'll all be aware of the EU Green Deal, which is striving to be where the EU is striving to be the first climate neutral continent, but there's an explicit goal of making that transition, just and inclusive for all. So yes, green, of course, is the focus of policymakers and investors, but certainly social issues are much more in focus today and will continue to be.
Right. Yeah, and if we look at a little bit, let's say, background, because these days, of course, we hear about sustainability or sustainable finance or in general climate finance quite a lot. It started quite some time, right? Climate change as such, at least scientifically, or scientists or academic community has seen the changes or in the environment, in the climate, for almost over a century ago, right? So they monitored or they identified the changes in the particularly climate change issues around 100 years ago. Since then, on political level, but also scientific level, also, let's say, civil society level, number of, let's say, developments have happened, which brought us to today, where climate change has become very, very, very mainstream topic. And as mainstream topic as, of course, for dozens of governments at present today, climate change is the highest priority. You probably also heard like let's say last elections in Australia, they were run only the majority or the prime topic of that whole election was around climate change, right? So it from being something which is more, let's say, a topic for interest for the scientists or for the researchers, to bringing this topic to the day-to-day activity of everybody as citizens, but also politicians and also countries. That's the change which we have seen on these topics, particularly climate change, but overall sustainability in the last, let's say, 1 century or as such. Now, when it comes to sustainability, and all of us are, of course, working in an environment, in an organization, some independently, but some in the organizations also. And when organizations or companies have a big role to play towards, let's say, sustainability or in sustainable transition as such. But when it comes to sustainability, and I'm sure you could relate to this picture to your organizations also, it really depends on whom you are speaking about sustainability, right? If you're talking to somebody who is working in finance department of your organization, probably they will simply see this as a cost. It's an investment where you need to spend some resources, right? Somebody who is into I don't know, into a marketing, maybe they see it as a very branding opportunity or promotional opportunity. Let's paint our logo green and that will make us green, right? Or somebody who is more, let's say, consumer side or consumers of those companies see it as simply greenwashing, that this is a phenomenon which is developed by organizations, but just as a PR exercise, or as a, as a marketing or, egoistic exercise as such. So what I'm trying to say is it really depends on what is the person's day-to-day job, what activity he or she is involved in, and that would also lead his or her let's say opinion or way of looking at the topic of sustainability very, very differently. However, it's not something one should limit to the role itself, but it's a matter as an organizations companies need to be taking forward. Now, okay, if as an organizations, if sustainability needs to be taken seriously, then many people, what they would also prefer to do, or you would see this happening quite some time these days, is, well, to putting together a CSR, corporate social responsibility or corporate sustainability policies, publishing some nice reports, publishing nice pictures about how we help our employees, how we created, I don't know, a medical camp for our employees, how we stopped using paper, or some of those very, very, fancy kind of, let's say, pictures and fancy kind of images and graphs, putting together in a report called CSR report, and asking the question to shareholders, or asking the questions to themselves, well, we have published our report. Are we sustainable yet? And this is what I would say, this is what sometimes also is causing, due to looking sustainability from more, let's say, marketing or more promotional side as such. However, is sustainability limited only to marketing, only to communication, only to CSR reports? Well, we will discover that in the following, let's say, slides as such. Now, often sustainability or climate change, or even let's say social challenges, inequality, all these topics are very, very complex ones. And organizations as such, companies, do not necessarily have that all capacity, knowledge, expertise, or support from stakeholders or from consultants as such, on understanding how, as an organization, be it law firm, be it AIFM, be it auditor, be it some other organizations, how can I accept sustainability, integrate sustainability into my work? Often this is a complex issue. Often this is not doable at organization level. So what you do, you depend on external organizations, such as some kind of certifications, some kind of ratings, which would help you to get into integrating sustainability into organizations. But then there are so many of these certifications today about everything, about food, about clothes, about paper, about organization, about electricity, about automobiles. everywhere there have been so many of these green certifications or sustainability certifications as such, as that the situation as of today is the certificates have been making the situation even more complex, because it's not very clear whether the certificate speaks about an assurance. Is it certificate you buy or you earn? Is it speaking about actual impact? Is it social? Is it environmental? Is it just good enough or it's better, right? So there are so many factors involved in sustainability or communication around sustainability, that somehow the certifications, which are often seen as a tool, okay, we don't know, we cannot manage that organizations or our limited organization, that's why we rely on external parties. But then the external parties like this certification even make things even more complex as such. Now, this is all about sustainability at company level or sustainability at individuals level. Any questions so far? Any ideas, any questions? Denise?
No, okay, if there are no questions, if we can maybe move on to the next slide. We wanted to take a look at basically risk. And this slide and the next slide are highlighting the top risk from the World Economic Forum's annual Global Risk Report. And the reason why we wanted to highlight these, this is from actually the 2020, the 2019 report, but basically the results are the same for the 2020 report. So effectively, this slide and the next slide highlights the same concerns of businesses, governments, and civil society. Namely on this slide, the highest impact risks of the next decade: climate action failure and other environmental risks. They're in the second and third spots. And in the next slide, you can move to that. It's the The next slide is the basically showing the highest likelihood risks of the next 10 years. So all of the people who are surveyed believe that the top 3 risks and the highest likelihood of those risks are extreme weather, climate action failure, and environmental damage. So clearly, obviously, climate risk, climate change, environmental extreme weather, and all of those risks are at the top of the agenda, if you will, of the public and private sector. And obviously, so we focus quite a lot on risks when it comes to sustainability. And obviously, that's also a very important element of the regulation that we're all having to implement, the sustainable finance disclosure regulation, focusing on sustainable risks. But of course, with risks comes opportunity. And in the next slide is just a screen shot of an FT article where in early 2018, where Al Gore was making the argument that climate risks equals enormous opportunities. And clearly, Mr. Gore is not alone today in making that argument. And you only have to, for instance, look at the Luxembourg government's strategy for a circular economy. And you can see the investment opportunities in existing and in many newly launched companies, many of them, in the private equity world or the venture capital space. And those companies are aiming at coming up with innovative solutions to move completely away from the take, make, and dispose economy where we are mainly today, to an economy where, quote, the word demolition will be deleted from the dictionary. And this was a comment made by Claude Termes recently during the announcement of that national strategy in Luxembourg for a circular economy. And maybe it's just interesting to hear what he has had to say after that. He said, demolition will be replaced by deconstruction. At the end of a building's life, it will be deconstructed and the materials reused. So you can imagine the business opportunities that a total transformation of an economy from where we're making and throwing everything away today to reusing everything. You can imagine the business opportunities that transformation will bring. And maybe if we can move to the next slide. So we just included a slide that you'll all be very familiar with, I'm assuming, the United Nations Sustainable Development Goals, the SDGs. So these are, in fact, not only important goals for the planet and humanity, but represent trillions of dollars or euros of opportunities. And clearly, public money is not enough. Private money is obviously very much required in order to have a chance of meeting the goals that are the SDG goals by 2030, as well as, of course, meeting the goals of the Paris Agreement and other sustainability goals. So yes, what does sustainability have to do with finance? A lot, if we actually want to, achieve sustainability, if you will.
Right. So we saw that, well, sustainability has something to do with as individuals, plus to the organizations where we work in. And those organizations have to do with sustainability as from finance perspective as such, right? So sustainability as Denise concluded, sustainability has a big role to play within the financial sector as such. But then what is sustainable finance, or what is it like all finance needs to include something to make it sustainable, or is sustainable finance on its own? It's something different completely than, let's say, private equity, the usage world, the real estate world, and then there is a new world called sustainable finance. Is it so? Let's look at a little bit in more detail. Sustainable finance refers to any form of financial services, be it private equity, be it the listed equities, be it investing in real assets, be it investing in insurance, be it investing in banking assets, any type of financial services which integrate environmental, social, and governance factors, ESG factors, into the investment decisions, into the businesses, and that have a lasting benefit to clients and society as a large, right? So you are not only including those factors, ESG factors, into the process as such, but you are also using them into investment decisions so that they have a benefit to the organization, to the invested company, but then of course society at large also, right? So any financial instrument, any financial services taking into consideration ESG could be gathered or could be put together under the big umbrella of sustainable finance as such, right? Each of those elements, ESG, of course, they are very much clear from what do they mean by, right? Environment has to do with environmental activities, any activity which, of course, positively contribute to bring environmental change, and of course, not harm anything which has, let's say, negative substantial impact or negative impact on environment, could be put together environment. We will go through them in detail. Social, any let's say indicators, any factors which are focused towards the well-being of people as such, people involved as clients, people involved as employers, employees, larger stakeholders, right, or society as such. All of those could be coming under S. And G, as a company, how good you are, let's say, structured, all related to the corporate governance. Again, stakeholders at large could be all coming under governance as such. We'll go into detail all of those factors in the following slides for sure. Now, here comes the jargon. You have seen probably these different names, and I mentioned earlier also when we started. Of course, this course we are calling ESG Investing, but this also includes the very many different terms which are ethical investing, green investing, impact investing, social investing, responsible investing. Each of these have certain differences in them. They're not all same, but at the end of the day, their goal is more or less the same. And therefore, all of that could be brought in there under the same umbrella of what we call sustainable finance as such. Does that mean that, again, does that mean that they are one and same? Not really. Does that mean that investors look at, okay, they invest in green because they want to invest in sustainable? Not really. It really varies from investors to investors, asset manager to asset manager, but also financial instrument to financial instrument. But at the end of the day, all that could be brought in under one umbrella of sustainable finance. Let's not go into too much detail of all these individually, but let's try to group them in two broad categories, in two main categories. What are those two main categories? One is ESG investing, other is impact investing, right? You earlier saw the picture of SDGs, Sustainable Development Goals. Let me quickly go through so that you have once more there, right? What are these goals? These are challenges which we identified as, let's say, nations, as societies globally. What are the challenges for our planet and we as a people, right? What are those challenges which we want to solve so that the well-being of individuals, societies, countries is good, right? So these are the challenges identified. They are grouped in 17 different goals as such, which we would like to meet by 2030. What does this mean? Let's take an example. Zero hunger. As you are aware, probably about 2 billion, probably you are aware, about 2 billion people on this planet still have an earning of less than $2 a day. What does that mean? They are not able to feed themselves properly or neither to their families. Meaning, what could be done in terms of providing food security for everybody on this planet, right? That's a goal of goal number two. Number two, zero hunger, meaning nobody sleeps hungry today, right? What could be done as companies, as societies, as investments? What could be done? Where could we invest? What kind of companies could be built? What kind of value chains could be built in order to, let's say, solve this goal as such? So all of these goals have certain theme behind them. So there is social equality, there is education, there is health, there is environment. So all of them are some themes, and those all themes have a positive impact, right? If you are creating a company in food security, for example, that has a positive impact to solve the challenge around hunger. If you are creating a company which is, let's say, in education, you are providing quality education in a reasonable price. What are you doing with that? You're solving the challenge around providing free or reasonable priced education, quality education to all, right? So by investing in these type of companies, you are trying to solve a challenge which we have as a planet or society. You are trying to impact, create positive impact. And that's what is called impact investing. Impact investing is you are investing in a company by choosing a theme to generate certain positive or social environmental impact, right? This is very important for firms which are in PE as such, because most of the impact investing at present, or a good amount of impact investing, let's say we look at the proportions and numbers of assets under management, are done through PE kind of companies. Because then again, the companies which are involved in such type of activities are reasonably small, are reasonably, let's say, not those listed companies as such, right? So that's the one side of investments, which is impact investing, where you want to choose a company to invest in based on its conviction and its activities to generate or to focus on certain positive social or environmental impact. That's one side of investing. Other side of investing, ESG investing, which is environmental social governance investing, where you don't really focus on companies based on their themes, based on where they invest in. Of course, you want to take care, or you want to make sure that they are not investing in anything controversial, right? Anything negative. But still, you're not selecting companies based on their activities. However, irrespective of where you are investing in, you are taking into consideration certain ESG factors. What do I mean by that? Let's take an example. I want to create, let's say, I want to invest in automobile companies. So what do I need to make sure? Well, let's make sure that the vehicle production, the facilities are good enough for the employees. Employees are not working overtime, or they are not, let's say, the health and safety of those employees is good. The vehicle which is produced has, let's say, has a proper, let's say, policies and procedures around what kind of carbon emissions it's emitting. Carbon is being emitted from those vehicles, right? So all what I'm talking about is doesn't matter whether you are investing in automobile, whether you are investing in banking sector, whether you are investing in media, in any type of those investments, you take into consideration and you review that company with using indicators which are environmental, social, and governance. And that type of investing is called ESG investing. So now you might ask question, is a fund which is investing in, let's say, robotics or rocket science, could this be a sustainable fund? Maybe, yes. Maybe it could be ESG fund, but not necessarily impact. Why it could be ESG fund? Because while choosing those companies which are active in robotics or active in, I don't know, rocket science, there are certain procedures, certain policies on ESG which are measured, which are valued, and which have some impact on the investment decision whether to invest in that company or not. And that could make them ESG oriented company, or a company which performs good on ESG. Could that be an impact company? Not necessarily, because what kind of justifications you are giving in order to say that investing in the robotics company, what kind of impact you are creating as such, or what kind of challenge you are going to solve, right? So that's the key difference which one need to understand. Yeah, go ahead.
No, I was just going to say the key difference, and I think this is the fundamental. These are fundamental concepts that our industry needs to understand, and actually not just the industry. I think the media and the like need to understand the distinction between these two types of sustainable finance investing, if you will. Because clearly, if you have organizations that focus on no fossil fuels and companies that are completely green, if you will, then clearly they're thinking about impact investing. And so it's very important that we in the industry, the financial services industry, actually do use this terminology appropriately and not mix up the two as well. And we'll connect that as we go along as well to the the EU regulation, the Action Plan on Sustainable Finance, in particular on the Sustainable Finance Disclosure Regulation, SFDR, which actually hopefully will help with the terminology and making it clear what we're talking about when we talk about impact investing, thematic investing, having a positive impact as well versus ESG investing, which is more about considering ESG characteristics in the investment analysis and decision-making process.
Right, right. One of the things which you might often also hear is transition. So impact investing is where a fund which could be impact fund based on companies which are already generating impact. So there is not much to do with transition. They're already generating impact. Whereas in ESG, this is all about transition. Because what you are doing, you're identifying, you're analyzing the ESG factors of that company. You as an active investor, active owner of that company, you're engaging with that company, telling them, advising them, maybe sitting on the board, guiding them towards the path of what we want to achieve under Paris goals, right? Under the COP21 2-degree goals or 1.5-degree goals, right? So ESG investing, to a large sense, is a transition investing. We want to improve and have a better future, and these companies are contributing with their own activities towards that transition of a sustainable future. Impact investing, on the contrary, is done in companies which are already having positive impact, right? Or which are meant to have positive impact, right? That's few things to take into consideration. Now, is it always, one question comes is it only to do something good? Not really. It has a lot to do with the, let's say, general investment management as such. By, let's say, ESG is about identifying risks and opportunities. Let's take an example. Those companies which decide, or those funds which have, let's say, understood the current health crisis and understood the risks or opportunities around investing in this health related issues, that's all, in some sense, that's all coming under, let's say, those characteristics which could be coming under let's say, ESG as such. So ESG could be a risk tool, It could be a tool for the governance of the funds and of the companies and the owners of those companies to understand and to make sure that their vision and their values are then well reflected in the decisions on investments also, where the fund, where the company is ultimately going to invest in, right? So please make sure this slide is going to be the basis of everything what we are going to do, not next 2-3 days, right? ESG and impact, that's how we will categorize. All this on the umbrella is sustainable investing, responsible investing, right? So all of this is together then brought forward as sustainable finance as such, right? Now, as some of you, or as most of you, work in PE companies as such, or PE related services as such, we need to also understand a little bit the chain, where is what. You have general investments which do not necessarily take into consideration any kind of ESG factors or impact factors. You have certain, let's say, responsible sustainable investing where there are portfolios, meaning the companies where the funds are investing in are going to be screened, are going to be selected based on certain screening as such. And then you have impact investing, which is very, very thematic. You invest in a theme. Theme could be green, theme could be social, theme could be education, theme could be social housing, theme could be healthcare, theme could be affordable, sustainable transport, anything. Basically, it's all about thematic investing. Then you have a bit of, let's say, impact first companies, meaning I'm fine to lose my financial return or have limited financial return. But for me, it's very important to have higher social or environmental return, right? So those are impact first companies. Venture philanthropy, where of course you put your capital into those ventures with some social and environmental goals. And then philanthropy, which is donation. Now you see a clear difference. Sustainable finance, sustainable investing is not philanthropy. It's not about losing money. It's making money by doing good, right? Or making money by doing right decisions on investing, which takes into consideration social and environmental factors, right? So that's a very, very clear difference. They're putting money into a sustainable company, a green company, a social company is not necessarily a donation. It's not charity. Of course, charitable organizations, high net worth individuals could put their money into donations to do certain, let's say, ESG activities or invest in like a hospital as a donation, right? That could be a donation also, but that's not really an investment as such. And that's the difference also to understand, that to not link impact investing or sustainable investing automatically always to philanthropy, but to understand also a bit of difference why they are so different. Yeah, Denise, anything? Anybody has any questions?
Doesn't seem to be the case.
Okay. Okay, very good. So there are companies which are looking for pure profit. There are companies which are looking for pure social, meaning I'm fine to lose money. And then there are companies which want to have financial return and market rate or even better than market financial return. But on top of that, they're not only happy to have market return, they want to have social or environmental return as well. And that is the kind of, let's say, companies which we are going to speak more about under this sustainable finance or impact investing as such. Okay, then let's move to the next slide. Okay, and here, well, just as you see,
Hi, Sachin. Hi, one question from Natasha.
Okay.
Yeah, I can actually put it my word. Hello, everybody. Hi, Dennis. Hi, Sachin.
Hi.
Yeah. Hi. No, I was just, well, what I observed is that, well, not all the impact funds or really cool funds are UCITS. Sometimes they're UCIs, sometimes they're, well, alternative, what type. So they're not under, actually not falling really under AFMD directive, or they're under de minimis rule. So basically these funds are great. They do good stuff. But the complication is that it's so complicated. Actually, it's almost impossible to get retail investors on board. Because first of all, it's kind of sometimes, well, MiFID doesn't help. MiFID says it's not for retail. At the same time, Bill Gates says that instead of trying, to take care of your garbage or taking fewer flights, it's actually better to invest. So I know you probably, well, you're not the regulators, but do you have did you find this golden nuggets where basically people, each of us who are probably on this course are struggling, what can we do for the future generation? Well, other than flying and not driving a car and stuff like that. And at the same time, where to invest, because sometimes the opportunities that we have, they're very limited actually for retail.
Yeah. Maybe two comments from my side. I mean, I think what's quite interesting is you'll be aware of the LTIF, right, which has had trouble, the European Long-Term Investment Fund, which is actually destined also for retail investors. And it's obviously it's taken some time for it to get off the ground. And but I think it looks like the policymakers are trying to get it off the ground, if you will. So that certainly will be one way that retail investors, and I don't know when that will be, but hopefully soon, will be able to invest in, longer term projects focusing on sustainability, social housing and other kinds of infrastructure projects, if you will. I think the other thing though too is with the development, with the introduction and the implementation of the Sustainable Finance Disclosure Regulation, I think that, and then the categorization of every financial product into Article 8, which is more or less like the ESG investing products, if you will, and Article 9, the thematic products. And then obviously everything else is this Article 6, which doesn't take into account sustainable risks, which, you would have to kind of ask how long of a shelf life will those products have. But I think that what we will see over the next year and obviously beyond is asset managers who, and I know this is obviously I'm talking about in the UCITS form, but I'm thinking of, access to retail investors. But those asset managers now are where they might have done some ESG integration because of the opportunities and because of the regulation with Article 8, Article 9, and Article 9 being the impact thematic investing. I think we're going to see a lot more asset managers launching those funds. Right, and they will be, it's just obviously not the theme of today, given the private equity world. But I think from a retail, you and I investing perspective, it is going to be fantastic because these will be more impact thematic opportunities in a UCITS, retail wrapper. So,
yeah, I think that's very important to note. More and more UCITS funds, more and more mainstream funds are trying to include the impact angle to it. Of course, this doesn't mean that, okay, let's invest in Amazon because Amazon creates lots of jobs, right? That's also not the aim. That's other extreme of, let's say, miscommunication. But still, the point is more and more, let's say, UCITS world is getting into impact. Second, answering your question, why is it so? Of course, one of the main reasons is risk. The asset class is so specific. Investing in renewable energy, or let's say the windmills around Spain or Portugal, not necessarily based here in Luxembourg. I would understand the risks of that, let's say, that those investing in those windmills or investing in a microfinance investment in Uganda through a Luxembourg fund. Probably I won't, as a retail investor, I wouldn't necessarily have all that expertise and knowledge to understand the risk behind investing in that microfinance company in Uganda, in Ugandan currency, right? So all those, one of the reasons why those structures are not open for retail investors is also around risks. But yes, more and more options are being made.
Yeah, and to Axel, and obviously what my answer was talking about, on the Article 9, Article 8 was talking more about actively managed funds, but Axel is absolutely right. Clearly there are sustainable ETFs, and more and more of those will be coming. So yeah, those are certainly more available to retail investors, put it that way. But again, if you're looking for a product that is managed by a manager and actively managed, then there will be that too, more of that as well going forward. So it's quite positive, actually.
In fact, if you look at the growth, recent growth, that's quite heavily represented by investments in ESG ETFs, right? So that's first, there are more and more of them. Second, they are growing also rapidly. Yeah. Okay, let's move to the next one. Now, we spoke about ESG and impact. Let's go a little bit more detail in what is all that ESG investing is, right? We mentioned that ESG investing is not necessarily investing in this or that type of theme, but it's any type of theme, any type of activity, as long as that is not controversial, but take into consideration certain ESG factors. And what are those ESG factors? Well, there are some of those very well known, such as for exclusions. Exclusions meaning excluding certain, let's say, companies based on what they do, right? Maybe tobacco, maybe alcohol, maybe nuclear. We wouldn't go in what is good and what is bad. We'll discuss that in detail. But just here to understand, excluding companies based on exclusions or certain sectors or certain screening. Second, best in class, meaning choosing companies only best in that particular sector or best in that particular category. Third, ESG integration, meaning when I'm looking at a company, whether this is good or bad for my investment, I'm integrating the ESG risk, whether this company will survive in 10 years, 5 years, 20 years, right? From the current context, ESG risks, but also opportunities from ESG side. Engagement and voting, meaning as an owner, as an investor, I engage with that company. I try to understand, I try to help, right? All that is related to engagement. Norm-based, all those norms, international labor norm, for example, human rights conventions, right? Or environmental norms, all those internationally, nationally recognized norms, investing in companies which follow those norms is also one of those strategies. Sustainability themed, very straightforward, investing in theme like forestry, like water, like housing, all those. And impact investing, we looked at in a little bit more earlier. All this will go a bit more in detail, but these are mainly the investment strategies as such, which are being applied while doing ESG investing as such. A lot of that relates to, of course, the mainstream UCITS funds, not necessarily in PE, because in PE you yourself are doing the due diligence as such as a GP. And therefore it might be a bit different, but still this is good to understand, good to know when people mean that they apply ESG screening, when people mean that they apply ESG strategy, what kind of strategies they are speaking. They're speaking about all of this. We at LuxFlag label about 200 funds. And we did a study. Denise,
yeah, ESG, yeah. No, I thought it was. I was just wondering whether we should do it now or later, but I'll do it now. I'll say it now. But it's true. It might give you. It might be interesting to get a sense of sort of which of these strategies are most popular, if you will. We LuxFlag produced a study of 123 ESG. LuxFlag ESG labeled funds back in September, which was the number. It's actually grown quite a lot since then, but 123 LuxFlag ESG labeled funds. Mainly uses, but as Sachin said, also some other structures. And out of those 123 ESG labeled products, it represented about 60 billion euro of assets under management. The ESG strategies employed were about 26% exclusions, 22% engagement or active ownership voting, 22% ESG integration, 17% norm-based screening, 14% best in class, and 1% impact in the ESG label. But that's maybe another story, another discussion. So the study showed that, although exclusions, seem to be the most commonly used ESG strategy, ESG integration and engagement are gaining quite a bit of momentum. And also maybe as opposed to sort of the early days of ESG investing, where you could just basically exclude a number of controversial sectors and activities from the investment process, and that was considered good enough. Today's asset managers tend to use to apply multiple ESG strategies, which is what we found in our study as well. And the vast majority of the LuxFlag ESG labeled products apply between actually 4 and 5 strategies in their investment processes. So, and I'm sure we'll see, if we do that study in a year, we'll see that evolve even more, probably towards, you know, ESG integration and engagement as well.
Yeah. So again, it started. All of it started with basically exclusions. And if we look at a little bit the history of whole ESG or sustainable investing, you could go back as much as to 14th century, where Church of England used to exclude certain sin stocks based on certain religious beliefs, right? So it's not something started just yesterday or just 5 years ago. It has its own traces, but still the modern, let's say modern sustainable investing exists in its current form for last 20 years or so. Of course, in Europe, Europe has been leader in sustainable investing for over decades now, and particularly all that for a long time has been mainly developed in the northern countries, in Scandinavia as such, the Dutch market, but then also by now, particularly in the last 5 years or so, managers across all European countries have been, let's say, looking at ESG investing as such, as part of their, let's say, investment strategies. Now, let's go a little bit more in detail about all those strategies which I mentioned, because this is going to be important to understand. When somebody wants to screen a portfolio, screen a company from an ESG perspective, what are they actually doing, or what are they actually supposed to, let's say, look at? Best in class, where, let's say, as the name says, you invest in companies which are only the best ones, right? Like, for example, I don't know, there are certain companies or certain sectors, certain industries, which by nature, by default, have certain controversies around, like, for example, mining, or like, so for example, I don't know, even some days I consider even banking as one of those activities where there are so many questions being raised, right? So if you are investing in banking, you invest only in big or let's say mainstream banks or best banks in that particular category. Or if you're investing in mining, you invest in only mining companies which have, let's say, responsible mining policy around, right? So all those selection of selection of companies based on only the best in that particular sector, best either in the universe, meaning the approach which focuses on the initial universe where to invest in, or best in effort, meaning those companies which might not be performing well or might have today certain ESG risks, but they have identified those risks and they have a concrete plan. And that's what best in effort is actually transition, right? That's what they are trying to do, is they have identified. Let's take an example of Total. Total is an oil and gas company, right? We know all the issues around oil and gas or fossil fuels, why they are not good, what is their effect on climate change, and why they need to improve, right? So as of today, we would all consider Total or any company which is in fossil fuels not necessarily an ESG companies. However, there are companies like Total, companies like BP, or some, I'm just taking some examples. I don't mean those companies, but still, there are some companies which have identified and understand the risk of investing in fossil fuels. They have understood that fossil fuels is not something going to be super popular as a sector in the next coming decades. So what they have understood also is what is the need of renewable energy, what is the need of alternative energy, and they have already put together a plan on how that company's activity is going to change. And not only activity, but the revenue model is going to change from fossil fuel based to alternative energy based or renewable energy based. If I'm taking an example of Total, I think they have 2030 target by which they want to go for something like 40% or so, right? So this understanding of how my current activity is not good, how I need to go for something good, right? Or what is going to positively contribute as such, and how I have made my plan, or what is the track which I choose to go for. that's all best effort, and that's all transition, and that could be still considered under, let's say, best in class strategy. Yeah. Next one is, well, I wouldn't go in every detail, but let's take an example here. This is a healthcare company. So again, these are mainstream companies. These might not be necessarily the targets for PE funds, but still, for example purposes, if we go to healthcare, you would identify companies which are top, look at the ESG scores of those companies, how those companies are then, let's say, looking at different elements, such as, for example, the criteria used in this examples are environmental management certifications, systems, or carbon intensity, or the carbon disclosure project participation. So there are certain criteria one could develop each sector, and irrespective of whether this is a listed company or private company, every sector has its own, let's say, specifications and criteria could be developed to understand the track, the path towards the best, the efforts which they make, and how this company could over time, let's say, perform well on the ESG side as such. I wouldn't go into those details. So first strategy was best in class, or alternatively also known best in effort also. Second one, ESG integration. What does this mean? Very simple terms. Wherever you are investing in, you know the company better, right? From risk and from opportunity angle. You don't just buy companies from the financial performance side or other type of indicators, but look at that company from, let's say, risk perspective also, right? Or the opportunity perspective also. I take an example of, again, opportunities as such. If somebody would invest in healthcare companies, or particularly those working around, let's say, the current pandemic as such, those companies have, let's say, brighter future from the financial side, but as well their contribution to the social issues as such, right? ESG risks as such, as you know, technology is creating huge disruption in everything. And those companies which exist today might not be existing also in 10 years or in 20 years as such, right? So understanding though, let's take an example of, for example, Facebook or Google, right? Those companies have huge regulatory pressure these days due to the privacy issues, due to the data of users of Facebook and Google and how they use that data. So imagine tomorrow if governments come up with such some heavy regulations around, around putting certain restrictions around Facebook, certain restrictions around Google, then what would happen to their pricing structure as such? And that could be then again, data privacy could be is one of the major, let's say, ESG risk as such. From social perspective, and regulation, or let's say government intervention, could change the future for these companies, right? So understanding the risk, but also understanding the future and taking that into consideration into ESG profiling as such. ESG integration could be done qualitatively, quantitatively, but also, of course, primarily it's used as in more, let's say, asset management strategies, but more passive and smart beta strategies. But that's, again, it's a very listed oriented side. It has, let's say, ESG integration could also, and we will be looking in the following modules how ESG integration works in PE fund side or PE equity side, PE side, but just for information purposes. Now, when you see that sustainable finance is growing, ESG investing is growing, a lot of that is meant by ESG integration is growing, because ESG integration is actually the most popular strategy. Almost every single manager or fund which claims to be sustainable actually uses this ESG integration strategy. Yeah. Any questions so far? Okay. Third one, active ownership. And here, if you are investing as a fund, as an active owner, you want to get close to the companies. How can you get close? By influencing investment decisions, by guiding companies on certain, let's say, certain risks or certain, let's say, opportunities as such, and how generally companies or how generally investors do that by attending the annual general meetings, by exercising the voting right as such, or giving a mandate to vote to a specialized companies which understands ESG issues as such. So active ownership voting is an important element to influence those companies in a positive direction from an investor perspective as such. If we look at active ownership engagement, here you identify certain issues. Like, for example, you are 10% shareholder in Facebook. You, of course, as a 10% shareholder, you want to write to the CEO of Facebook and understand from him what is his policies, how he is going to react to any of the regulations which governments could bring in on the data privacy side. What is really the matter around data privacy, how Facebook is dealing with that, right? So all that engagement with company, identifying ESG risks, identifying ESG challenges, and asking questions, guiding companies, sitting potentially even on the boards of those companies, influencing them in all ways so that they go on the right track. That's what is all about engagement. So does this mean that you need to engage with every company? In the listed equity world, not really, but in private equity world, yes. Here you are in engagement with, by default, with every single company. Every single company, you have your own due diligence, you have your own, let's say, indicators as such, you have your own meeting. You are not dependent on external data as such, not to that extent as the listed equity world is. And therefore, active engagement, active ownership is such, I keep calling it, it's a default strategy for PE. It's inbuilt strategy for PE. Every single private equity fund, every single private equity investor is by default an active owner, because that's how the PE world works, right? So, but that's not necessarily the case in the listed equities, and therefore this is also an important strategy which is being more and more used by the listed world. Exclusions we spoke about. Here again, we might have very, very different opinions about what is good and what is bad and what is controversial and what is not controversial. I wouldn't go in much detail because even in 27 member states here in Europe, we have very different understanding about whether nuclear is good, nuclear is bad, whether nuclear would help, nuclear would not help, right? The same thing about alcohol. We have, some of our, let's say, member states have predominantly alcohol companies around fund industry as such. Most of the funds investing in them. Some countries have strict policies around, let's say, every alcohol company must have a responsible consumption policy. Only then they are awarded with the license of selling alcohol as such, right? So there are sectors and activities which we have different understanding as societies, as countries, as investor groups. And therefore, there is no one full list of everything good and everything bad, but still from a conduct base, from a responsible citizen basis, from responsible corporate basis, whatever we consider as controversial, like, for example, war is bad. There is nobody there who would consider war is good, right? So weapons, production of weapons is bad, or production of anti-mines there, or production of, I don't know, in some cases, maybe somebody might think also nuclear, right? So those things, identifying them and making sure that the funds do not have any exposure to those controversial activities is called exclusions as such. And this is a strategy which is, again, very, very well known. There would be hardly any fund, or there is no fund exists which is, let's say, ESG fund, or which is a sustainable fund, but doesn't know what is exclusion, right? So this is, again, an inbuilt strategy every other, let's say, asset manager is expected to use and is using.
Yeah, maybe just 2 points on that. I mean, it's kind of, in the eye of the beholder, right? That's an important point, right? As you rightly said, one person's exclusion is one person's investment opportunity. If you speak about alcohol, for instance. I think the other point to make as well, though, is that this is evolving, right, over time. And we see that, I'm sure, I know you see that, Sachin, as well, in discussion with the asset managers, who apply and have their funds, where their funds are labeled by LuxFlag. And, even things like, tobacco, maybe 5 years ago, that wouldn't have been high on anyone's exclusion list, but it's, now it is almost on everybody's. So, I think that the evolutionary nature of exclusions is quite interesting to observe as well.
Yes. We at LuxFlag, or let's say, there are no, let's say, formal policies around exclusions. Certain institutions which have, let's say, supranational mandates, such as the European Investment Bank, the World Bank, the IFC, International Financial Organization, then some development banks which have public nature. Of course, they issue exclusion list because they have a public mandate as such. But on the private side, let's say, it's a very, let's say, different world. One of the private exclusion list, which is very many times used by, let's say, PE firms also, but also broad scale of asset managers, is the exclusion list of Norwegian pension fund, which is considered as extensive enough and quite frequent updates to that, and therefore people might have two ways of excluding things. One, companies, so they might have a list of 100 companies, 200 companies, 300, whatever, a list of companies and names which they consider as exclusions or exclusionary or controversial companies. And second, the second type of, let's say, investors or asset managers, which would define certain sectors, certain activities, such as I said, nuclear, alcohol, controversial weapon, conventional weapon, hydro, large hydro. So there could be, many of those sectors, activities, which could be excluded. There's one new trend which also is there, is to consider the thresholds. Look, for example, and that's important to understand, is if you are investing in, let's take an example of Auchan, right? Auchan sells alcohol, Auchan sells tobacco. Should we stop investing in Auchan tobacco? Not really, because the percentage of turnover, percentage of revenue of Auchan coming from sale of tobacco or alcohol is really negligible compared to their overall turnover, right? So looking at the thresholds, looking at the turnovers is also important when we exclude companies based on their, let's say, activity or sector they are involved in, right? Now, one example which I thought I should give here is the Luxembourg Sustainability Bond Framework, which is the Luxembourg's government's sovereign sustainability bond, which of course excludes certain sectors or activities. And here you will see nuclear power generations or fossil fuel production or infrastructure which uses fossil fuels, production or trade of tobacco, production or trade of alcoholic beverages. So again, it's just the guidelines, right? It's just an example. It doesn't mean every single company, every single asset manager uses similar type of exclusions as such. Yeah. Now, any questions so far? So we looked at 4 or 5 different strategies. Best in class, important, where you invest in only best companies from that sector. Then ESG integration, also important, where you look at companies from risks and opportunities perspective from ESG. And as I keep saying, ESG integration is something, again, very inbuilt for PE, because PE funds, the GPs are meant to look at companies, do the due diligence, prepare the whole investment proposal as such for investment committees. And while doing so, integrating ESG factors is something becoming more and more common, right? So the difference, as I keep making, is the PE funds are not dependent, or GPs are not dependent necessarily for the data on external data vendors, as opposed to those in the listed equity world. So best-in-class ESG integration, active ownership, where you exercise your voting right, you exercise your power as investors to influence the companies. And fourth, exclusions, you exclude certain companies from investment universe and investment portfolios, right? So those are what is called ESG strategies. And when somebody says, I am an ESG fund, what do? They apply these ESG strategies. So the portfolios, the investment portfolios or companies where they invest in, are necessarily then screened against those ESG strategies as such. Yeah, so let's take an example of, and again, I'm giving an example of a main UCITS fund, but could apply also for a PE fund also is, let's take an example. You select a sector, let's say technology companies. I want to create a fund of technology companies. So I select technology companies. Let's take an example, 500 global technology companies. That's my universe. I apply best-in-class strategy. I look at different regions. I look at within technology, I don't know, the digital, the telephony, the electronics, right? So different sectors as such. I look at and I choose best of the best companies. So from those 500 universe, I come to maybe 300 companies, right? Then from that 300 companies, I apply exclusions. I invest in only companies which are, which are not into any controversial side, not operating or are located or making any revenue from any of the sanctioned countries, sanctioned regions, whatever. Again, exclusions is again very difficult topic, but whichever you use, you apply that strategy and you come from 300 to 100 companies. Then you apply ESG integration, you update your due diligence with ESG risks and opportunities, you identify companies rating, ESG rating or ESG profile from ESG perspective, and then you decide that, okay, I want to invest in only A+ companies, not anymore. And then from 100 companies, you come to only 20 companies, and you then build an investment portfolio of that 20 companies. So the whole process of coming from 500, applying best in class, applying exclusions, applying ESG integration, and building a portfolio is all what is ESG. That's the investing process as such, or that's how it works as such. Now, the data and all that part will go in more details in the following slides. Yeah. Now, one more strategy which is important to consider, as I mentioned, is impact investing. And impact investing is directly related to a particular theme or to particular activity, and what exactly then it would is impact investments are investments made with an intention to generate positive, measurable social or environmental impact alongside of financial return. Now, one main thing to understand, no impact investment company is supposed to lose money. At the end of the day, it is an investment, meaning the investor is seeking a return on their investment. It's not a philanthropy, right? Who is making impact investments? Individuals and institutional investors. If we look at where is impact investing being made, it's more the private companies, right? It's more the non-listed companies. And how does impact investing perform financially? Well, of course, they have diverse financial expectations as investors, but overall, the meaning or the reasoning of all that is making money as well, right? So that's again, if I were to broadly categorize the PE world and the listed world, there are more and more PE funds investing in more impact investing as compared to ESG, whereas there are more listed company world is more ESG funds are investing in, or the listed funds or listed companies are more on the ESG side as such. However, things are changing now these days. I mean, you will see more and more PE asset managers are also becoming signatory of something called UNPRI. We will look at that in detail later on. But the principles for responsible investing, more and more PE funds are looking at ESG from risk management perspective. So the risk tools are taking into consideration ESG as such. And with the regulation change, then this distinction between PE is meant for impact investing, ESG is meant for listed investing, that is going to go away. Everything is going to go more and more or come together more and more. However, by default, the nature of those companies is going to be impact companies are going to be still relatively small in volume and in number compared to the ESG companies as such. Yeah. Now, we looked at the ESG strategies. Now we look at why at all of this is needed, right? And why we are at all, why there is so much of this momentum around ESG as such. Of course, ESG or impact investing as such. of course, there is one reason or one driver of that is this public and political awareness around this whole story. There are more and more people speaking about it, more and more politicians speaking about it, and that has an impact around let's say, investments as such. Now, investors are looking at it, more and more investors are asking for that. And then the third driver is also the regulators. More and more regulators, policymakers are looking at that. And that's why this whole sector as such is really the hot topic of the financial industry. At the same time, people do it for different reasons. Some people might be doing it only for compliance reasons. Because there is a regulation, you must do it, you cannot run away. Because there is a huge communication opportunity. If you don't say anything about ESG, if you don't do anything about ESG, you will lose, right? So there is a communication element, but most important element, in my opinion, is spirit also, because we should believe, and it is of course proven, that investing with certain ESG nature allows you to take all those risks in consideration and allows you to take also consider all those opportunities. And so overall, ESG is not something, let's say, out of the scope of typical investment analysis and investment process, but it should be within the spirit of investing. And it makes sense, and that's why we should be doing it rather than for communication or compliance purposes. Denise?
No, I have nothing to add. And in any case, now we will have to do it with the regulation. So I think that the policymakers in the EU have the desire to make all finance sustainable finance. So we are on the journey to that.
Right. Now, if we look at the drivers in PE, and this is a study made by PwC, where, as I was mentioning earlier, more and more PE companies are considering ESG as risks, or it helps to identify the risks. Let's take an example of what kind of risk. Like one of the main, let's say, element on ESG is climate change, right? Climate change is causing huge disruption, disaster around the world, right? So if your company is going to, let's say, have a physical risk, like if the company is not going to be able to operate in a country, in a region where it is operating or where it is making money from, of course, that's a risk, and that should be taken into consideration in risk management, right? If due to the, let's say, pandemic, if half of your employees are not going to come to work and whole your, let's say, systems are going to change, that's a risk, right? So that's an employee risk, and that's a resource risk, and that should be taken into consideration, right? So a risk doesn't necessarily need to always limit to operational and financial. There is a whole lot to do of risks to, let's say, the social and environmental side, and therefore more and more people are trusting this, that if we look at companies from ESG perspective, we would be better able to manage the overall risks of investment companies as such. Investor pressure, 24%. Of course, there is hardly any investor who is not speaking about ESG, right? So it's absolutely important. Opportunity, 15%. Remember the SDGs, how many people we have, how much work needs to be done so that everybody on this planet has enough food, has enough education or good education, has clean drinking water, has has good jobs, equal opportunities, has good sustainable transport in their cities, right? So the challenges are not less, and therefore there are huge opportunities to make investments in particularly those sectors which are identified in the SDGs. Corporate values, of course, as corporate citizens, more and more companies are adapting towards sustainable values as such. Regulation, it's a bit old study. Today, I would say this 7% comes to 70%, right? But yeah, I mean, regulation is coming and one cannot, pass by. senior partner pressure, of course, individuals behind those companies, the GPs, the LPs, they are also highly, let's say, pressurizing or having this all into consideration. And therefore, these are, let's say, the main drivers of ESG into PE as such. Yeah. Okay. Then now, yeah, just I'm looking at the questions if there are any. Yes.
Maybe Stefan's question. I told Natasha that I said thank you for the ability to have a commercial moment, but we'll get to that question maybe by, before the course ends, but maybe just in the interest of time.
Though we didn't plan too much explain.
Yeah, exactly.
But
we will. Stefan had a question. Stefan, you had a question? Also LP's interest.
No, it was more a comment. I mean,
okay.
Also, I mean, the LP's profound interest for ESG kind of investments, but also a kind of, which could turn into a pressure for GPs to also explain in detail their strategy in the future, could make you then again very competitive compared to your other peers. Just wanted to add that.
Absolutely right. Absolutely right. Yeah, the investor pressure is going to is a big part of what's making it happen. Yeah, you're right.
Yeah. Okay. Then well, yeah, exactly. Here you have all the elements, Stefan, you were mentioning anyway. The stronger brand and greater pricing power, which ESG is going to let's say provide to PE companies. It provides greater operational efficiency. It also provides optimization in terms of supply chain. So there are good, let's cut it short. There are good enough reasons or enough reasons to consider ESG and its impact on overall, let's say, investments in PE. Yeah. Now, this slide is important. I will make sure we start with this slide tomorrow, but for the time being, we just can move on because this will take a bit time. So I would then go for the ecosystem as such. So we understood a little bit about ESG, about impact investing, about why sustainability, why it is important, how sustainable finance is organized between ESG and PE. What are the drivers? ESG and impact investing. What are the drivers in PE to consider ESG? How PE is moving more towards ESG as well than just impact investing. Now let's look at who are, let's say, the core actors as such in the ecosystem of sustainable finance. Well, of course, investors, the LPs, they are, of course, very important stakeholders. Also, the regulators, the regulators and policymakers have an important role to play, and they are becoming more and more active. And we will go in detail about the SFDR, but still, I consider them as a very important, let's say, element of this sustainable finance ecosystem. Fundraising side, the capital markets, the non-bank solutions, of course, they are important. Governments are important. The green finance verifiers or certifiers like ourselves, LuxFlag or others are important. People, the talent and human capital is, of course, extremely important as such. As a let's say in the ecosystem of sustainable finance. Now, if we look at the Luxembourg ecosystem, I wouldn't go much in detail. You know all of this, but of course, coming from the UN SDGs, which were launched by the United Nations, adopted by the EU, Luxembourg government, EIB, and different actors which we have in Luxembourg, which of course are in one or the other way involved in sustainable finance as such. Yeah. So
and Natasha has a good question, a good point about the history of sustainable finance in Luxembourg. That could be worth. I mean, do we have a couple of minutes? Yeah, maybe Sachin, just a couple of words, because obviously LuxFlag was one of the early players in that. Maybe that's worth just spending a few minutes on that, kind of give the overall local context. Yeah.
Yeah. Luxembourg has been, well, from the beginning, member of the United Nations. So all the work around development finance as such, as a let's say, humanitarian assistance to countries outside, has been part of Luxembourg's policy for over, decades and decades. However, if we look at more commercial side of sustainable finance as such, Luxembourg has been perhaps the first country to launch a commercial microfinance fund, which is actually in private debt back in 1997. So that was more or less, let's say, a starting point of, let's say, entering sustainability or ESG into the commercial fund space as such in Luxembourg back in 1997. Since then, we have, of course, Luxembourg has become the leading place for microfinance investments. About 62% of global assets under management are domiciled here in Luxembourg, and that momentum has happened between 2001 to 2010 until today. We of course lead, and good to know is all of those funds, about 45 funds which are in Luxembourg, have a good amount of, well, majority of those investments are in debt, private debt, and a part of them are in private equity. So those companies where the funds are providing debt are also, the investors, the funds are also taking equities in that. And there is a whole discussion about responsible exit and all that. So PE had a very, very important role as such in the whole microfinance journey of Luxembourg. Now, since 2010, of course, a lot of discussions also have been started around whole, let's say, climate transition as such, and what roles countries and financial actors could play. Luxembourg had, let's say, green ecological funds for some time, but whole momentum came in, let's say, last 5 years as such. And last 5 years have been also predominantly also coming towards or focus towards ESG as a broad sense as such. As of today, we have multiple organizations. So we have LuxFlag, which has been the pioneer in sustainable finance in Luxembourg since 2006. You have number of trade associations, number of associations, including LPA, who have specific working groups, specific, let's say, expert groups in sustainable finance as such. You have an accelerator which is created by the Luxembourg government to help newcomers to the climate finance world. So if a fund manager or if somebody has an idea and wants to create a fund, be it PE or particularly PE side, because this is going to be a PE or PD fund. So there the accelerator helps with some seed money, but also the training. There's a whole program between Luxembourg government and EIB around financing those projects. So there are quite many of those actors, including, let's not forget, LGX, Luxembourg Green Exchange, where green securities could be listed. So there's a whole lot of ecosystem which we have built in Luxembourg, which of course makes us, if not the top, but one of the known center of excellence in sustainable finance as such, not only in Europe but globally.
Okay, well, I think in the interest of giving you 2 minutes before your 2 o'clock calls, I think maybe we should end here. Hope it was of interest to you, and again tomorrow back at the same time and focusing a bit more on data, on reporting, due diligence, some of the standards, sustainability standards and principles, and then some of the regulation that we've been talking about, SFDR.
Thank you, Denise. Thank you, Sachin. Very interesting presentation. So great. If we don't have any questions, yes, I think that we can meet tomorrow same time.
Great.
Thank you very much.
Thank you very much, guys, for the presentation.
Thanks.
Thanks. Bye-bye.